Hello, I'm Joseph Graff. This video is one part of a 500-part video series where I analyze the 500 largest companies in America. If you'd like to check out my other videos where I conduct stock analysis on other companies, I will include the link in the description. Also, I'd like to say that if you enjoyed today's video, please make sure you hit the like button and subscribe to the channel. Also, hit the notification bell so you'll be notified whenever I post future updates. Lastly, I'd also like to talk about M1 Finance. M1 Finance is running a great promotion right now where if you sign up using my referral link, we both receive $10 that we can use to invest in the stock market. I'll include my referral link below. Thank you all for watching, and here's the video. Bank of America was founded in 1998 after Nations Bank acquired Bank America. They specialize in commercial banking. Some of their notable services include consumer banking, global banking, and wealth management. Bank of America's operating segments include consumer banking, global wealth and investment management, global banking, global markets, and other. In 2019, the company's largest segment was consumer banking, which earned them $38.6 billion in revenue. Consumer banking has been growing the quickest for the company, as they had a 2.6% increase in revenue between 2018 and 2019. Bank of America is currently the 16th largest company in America and is valued at $244 billion. In this next slide, I will be talking about earnings and earnings growth. These two metrics are important because they are the driving force behind a company's valuation and thus the company's stock price. Companies usually report their earnings every quarter. Large, stable companies tend to have positive earnings, while companies with high growth potential may operate at a loss in the hopes that they will become profitable in the future. Understanding a company's earnings and earnings growth goes a long way in being able to accurately value a company. In 2014, Bank of America earned 42 cents per share. In 2015, that number jumped up 211% to $1.31 per share. In 2016, they earned $1.49 per share, which was a 14% growth year over year. In 2017, they earned $1.56 per share, which was a 5% increase from the previous year. In 2018, their earnings jumped up to $2.61 per share, which was a 67% increase. And in 2019, they grew their earnings 5%, posting $2.75 per share. This data indicates that Bank of America has grown their earnings on average 46% per year since 2014. Now that we've looked at the company's earnings, we will now talk about its price to earnings ratio, also known as PE ratio. PE ratio is calculated by dividing a company's price per share by its past year's earnings per share. Generally, companies with low PE ratios are considered value stocks, while companies with higher PE ratios are considered growth stocks. PE ratio is a useful metric for understanding how Wall Street feels about a stock. In general, a stock with a PE ratio under 15 means investors are somewhat pessimistic about a company's future, while a PE ratio above 30 indicates that investors are optimistic about the company's future. As of June 8, 2020, Bank of America was trading at $28.54 per share. This represents a trailing 12-month price-to-earnings ratio of 11.65. This is lower than the trailing 12-month price-to-earnings ratio of the Standard & Poor's 500, which at the time of this recording was 23.18. In this next slide, I will be talking about the company's price-to-earnings growth ratio, also known as PEG ratio. This ratio is calculated by taking a company's PE ratio and dividing it by the company's growth rate in terms of a percentage. It is generally thought that companies with a PEG equal to or around 1 are fairly valued. Companies with a PEG above 1 may be overvalued, while companies with a PEG ratio below 1 may be undervalued. PEG is a popular metric among many investors because it takes both a company's earnings as well as earnings growth into account. As of June 8, 2020, Bank of America was trading at $28.54 per share. This represents a trailing 12-month price-to-earnings growth ratio of 1.31. This indicates that Bank of America may be overvalued if this is the sole metric you use to value the company. In this next slide, we will go over the company's dividend yield, dividend growth rate, and dividend payout ratio. Dividends are generally a sign of a healthy, profitable, mature company. It does, however, indicate that the company feels it has limited growth prospects as the company is choosing to pay cash to shareholders rather than reinvesting it into growth opportunities. Dividend growth rate is the rate that a company grows its dividend payments year over year. A high dividend growth rate is usually seen as a positive to investors. Dividend payout ratio is another important metric. It represents the percentage of a company's profits that it pays out as dividends. A payout ratio below 60% usually indicates that the company's dividend is safe and has room to grow in the future. A payout ratio above 100% means the company will almost certainly cut its dividend, as that means that the company is paying out more in dividends than it is earning. As of June 8, 2020, Bank of America currently offers a dividend yield of 2.8%, as they pay 18 cents per share per quarter. Bank of America most recently raised their dividend in September of 2019 when they increased it from 15 cents per share per quarter to 18 cents per share per quarter. Bank of America over the past 5 years has increased their dividend by an average of 29% per year. Bank of America's dividend payout ratio is currently 11.7%. This indicates that they have quite a bit of room to grow this dividend payment in the future. In this next slide, we will be going over the company's price-to-book ratio as well as its debt-to-equity ratio. The book value of a company is essentially the value of all of its assets. Book value per share is simply the book value divided by the number of outstanding shares. Furthermore, the company's price-to-book is just its price per share divided by its book value per share. This metric can help you understand if a stock may be undervalued or overvalued. A company's debt-to-equity ratio is calculated by taking the sum of all of its debts or liabilities and dividing it by the total shareholder equity. In general, companies with a lower debt-to-equity ratio are better equipped to withstand an economic downturn. Debt, however, can be used by companies to grow and expand, which is why a high debt-to-equity ratio is not necessarily a bad thing. As of March 2020, Bank of America had a book value per share of $27.84. This represents a price-to-book ratio of 1.03. As of April 2020, Bank of America had a debt-to-equity ratio of 1.06. This is on the higher end for companies in the Standard & Poor's 500, but is pretty reasonable given that they are a bank and banks make a lot of their money by lending out money to people. In the next slide, we will look at the company's 3-year, 5-year, and 10-year return. A company's past performance does not predict its future performance. However, it does allow you to see how a company has done in recent years. In general, a steadily increasing stock price indicates a company has been operating successfully. If you had bought Bank of America stock on June 8th of 2017, held it for 3 years and reinvested all the dividends you received, you would have seen an average annual return of 4.8%. If you had bought Bank of America stock on June 8th of 2015, held it for 5 years and reinvested all the dividends you received, you would have seen an average annual return of 9.2%. If you had bought Bank of America stock on June 8th of 2010, held it for 10 years, and reinvested all the dividends you received, you would have seen an average annual return of 6.4%. In this next slide, I give my grades for this stock. I'll include grades for how I feel this stock is as a defensive investment, a growth investment, as well as an overall investment. My defensive grade takes into account how well I think the company would do in an economic downturn. My growth grade for the company takes into account how much I expect the stock to grow in future years. Finally, my overall grade is my personal opinion on the stock and whether I feel it is a buy or a sell. Keep in mind that these are my own opinions, and I am not recommending you purchase this stock or make any investment without doing your own research. As a defensive investment, I gave Bank of America stock a B-. While I do think that they have a pretty attractive valuation at their low PE ratio, I am a bit worried about how they would do in a recession. As a growth investment, I gave them a C. Like I said, Bank of America is a company that does well when the economy is doing well, and it seems like we are currently towards the end of the economic cycle and may be headed for a recession soon. For Bank of America's value at their current price, I gave them a B+. About a month ago, I would have given them an A+, as they were at around $20 per share. Now they're at about $28. Their book value is sitting at right around 1, and I do like them at this price, but not nearly as much as I did about a month ago. As an overall investment, I gave Bank of America a B. I think Bank of America is one of the best bank stocks that you can own. I'm just not super excited about the banking sector in general at the moment. That'll wrap up today's video. If you enjoyed the video, please make sure you hit the like button down below and subscribe to the channel. I'll be doing this type of video for every stock in the Standard & Poor's 500, so keep your eye out for future videos. Thanks again for watching and take care.